Hello and welcome. Today we're looking at managerial accounting idea or principles of accounting, variable costing, and analysis. All right, one thing that happens is our traditional income statement looks like this. Our traditional income statement is sales minus cost of goods sold gives us gross profit, minus Sgna, it's selling, general, and administrative, or G&A expenses, gives us profit. Now there's no tax here, so this would be net income, net profit, net earnings, however you want to say it. Now for internal use, this variable income statement is better for decision making. Sales minus variable costs gives us contribution margin, minus the fixed cost gives us profit. Now the traditional looks at kind of product cost and period cost. So cost of goods sold is the cost of the products that we sold, and then we have period cost. The variable costing statement looks at variable costs, costs that change with volume, and fixed costs, the total costs that stay the same. Now we can show this. We're going to do both these income statements with two different problems. So let's set up what we know for problem one. So let's say, now we're just going to make up a little problem where we have year 1, 2, and 3, and let's say that we sold every year. We sold 2,000. Now we're building a little problem where it's going to show us the difference in how these two methods, variable costing and traditional or full costing, how they deal with the fixed cost, the total fixed cost for our products. So this is going to be where the difference is. So I'm going to highlight this and say the difference is how we handle fixed product cost. So we sell 2,000 every year. So let's say we produce 2,000 the first year, 3,000 the second year, and then we reduce our production down to 1,000. So we sell 1,000 in ending inventory and then 1,000 from year 3, and that's the 2,000. Now let's assume that our product costs are, we have fixed cost of 20,000 and our variable cost of $20 each, and our Sgna, the cost of running our business, is going to be $12 for variable per unit we sell and $8,000 total fixed cost. And we're going to sell everything at a price of $50. All right. So one of the things we need to calculate, and that's kind of difficult, is to calculate cost of goods sold. We need to calculate the cost of goods manufactured. So this is not given. We should be able to calculate this. But the cost of goods manufactured, the cost formula to make a single product is 20,000, that's the fixed component, plus $20 times every unit produced. So that's our cost of goods manufactured. Then, to get to the cost of goods sold, we need to figure out our cost of goods manufactured divided by the units produced and get a per unit times the units sold, and that will give us our cost of goods sold. Now the Sgna costs are just simply going to be 8,000 is fixed plus the $12, which is this $12 times the units sold, and that's going to be times 2,000 every time. So we're going to calculate the traditional income statement and then the variable income statement. All right, so let's calculate the traditional income statement. So we have 2,000 times the $50. So we have sales of 100,000. And we can go all the way across. It's going to be the same thing every time. Now to get cost of goods sold, first we need to calculate cost of goods manufactured. Now this is going to be the 20,000 plus the $20 times the number of units we produced. Now we need to put the $20 times the number of units produced in parentheses first, and then add it to the 20,000. So our cost of goods manufactured is going to be 60,000. Our cost of goods cost per unit is going to be the 60,000 divided by the 2,000 we produced, divided by the 2,000 we produced. So it's $30 each, and our cost of goods sold is the $30 times the 2,000 that we sold. So our first year cost of goods sold is going to be $60,000. Our gross profit then is going to be $100,000 minus the 60 and gives us gross profit of $40,000. Now our SG&A cost is going to be $8,000. Start with the $8,000 plus the $12, point to the 12, times the unit sold, here in this case is the 2,000. So that's going to be 32,000, and that's going to be the same all the way across. So for the year one, 40,000 minus 32, our year one profit is $8,000. All right, now this one's easy because cost of goods manufactured and cost of goods sold is the same, right? We produced 2,000, we sold 2,000. It's easy to figure out cost of goods sold in this case. Now we're going to do year two, and it's a little more tricky. Now, the sales are still going to be $100,000, which is the 2,000 sold times the $50 each. Now, to calculate cost of goods sold, we need to do cost of goods manufactured. So it's going to be the 20,000 plus, start our parentheses, the $20 times the 3,000 that we produced. So to make 3,000, it took $80,000. And so 80,000 divided by the 3,000 we produced is a cost per unit of 26.67 cents, essentially. This is economies of scale. You remember the idea of economies of scale is, yes, the total costs go up, but the cost per unit goes down. We're getting more efficient. We're using the same fixed cost and producing 3,000 rather than 2,000. So this $26, so the items cost $26 in year two times the 2,000 we sold is going to be $53,333. So our cost of goods sold is $53,333. We subtract out the 100 minus the 53,333. We were left with 46,667. Our SG&A cost, SG&A expenses, are 32,000. So if we subtract this out, we can subtract 46 minus 32 gives us 14,667. Our profit went up. Why? Our profit went up because we produced more, not because we sold any more. So this is kind of weird what happens with the traditional income statement, the full costing, that it says, hey, if you produce more items, the cost per unit goes down, and therefore our cost of goods sold goes down as well. So we reduced our cost of goods sold from 60,000 down to 53,333. So we generated an extra 6,667 in profit just because we produce more. Well, this happens if we produce more than what we sell. Year three, we're going to produce 1,000 and sell 2,000. Where do we get that other 1,000 we sell? Is from year two. So we know those items have a cost of $26,667. All right, so we've got to be careful on this one. So our cost of goods manufactured is going to be the 20,000 plus, start our parentheses, it's going to be $20 times the 1,000. So this costs $40,000 to make our 1,000 items. If we take the 40,000 divided by the 1,000 we produced, this one costs $40 per unit. $40 per unit. Now, what is this? This is the opposite of economies of scale. This is diseconomies of scale, right? If you produce 1,000, it costs you $40 each. So what's our cost of goods sold? Well, we have 1,000. We're going to have to do a calculation. We have 1,000 times the $26 from last year, we sold those, plus 1,000 times $40. So that's going to be 66,667. So year three, we still have 100,000 in sales. We're going to have cost of goods sold, but it goes up, and so our gross profit goes down to 33,333. Our SG&A is still going to be 32,000, And if we subtract this out, 33 minus 32, we're talking barely a profit of 1,333. All right, let's show you how this, by the way, this goes to the public. This is what the public would see. And I know it's a little bit strange. It's forced to say you're going to sell exactly the same amount, but we have different productions. Just to show you how it works, right? So variable income statement, we're going to have 100,000. We're going to take the $50 times the 2,000 that we sold. And I can just copy that across. That's 100,000 every year. Our variable cost is going to be just the variable cost. So it's going to be the 2,000 that we sold times, and we'll just add the 20 is variable cost, plus the 12 is variable cost. Close our parentheses, make those absolute address. So it's going to be 64,000. We can just copy that across. Our contribution margin is going to be 100 minus 64,000. And once again, we can copy it across. Here's what you're noticing. It's going to be the same profit every year if we sell 2,000 units. So what's our fixed cost? Our fixed cost is 20,000 plus 8,000. So that's 28,000 all the way across. And so 36,000 minus 28,000, we've got $8,000 profit year 1, 2, and 3. Now let's look at this. On the traditional income statement, the year 1 we produced, in fact, let me move this over just a little bit. We produced 2,000, 3,000, and 1,000. We sold 2,000, 2,000, 2,000. Now, our total production was 6,000 and our total sales were 6,000. But here's what happens. If the production equals the sales, so year 1, 8,000 equals 8,000. If production equals the sales, then we're going to have the same profit. If the production, like year 2, the production is greater than the sales, then the traditional is going to have a higher profit, 14,000 versus 8,000. The traditional will have a higher profit. If production is less than sales, if you produce 1,000 but sell 2,000, so inventory is going down, then what will happen is the traditional will have a lower profit. This is only 1,333 versus 8,000. Now watch, what's the total profit we have here? The total profit is 24,000. What's the total profit over those 3 years? 24,000. So these would give us the same answer if the production equals the sales or over a long period of time. But traditional is weird in the fact that you can produce more and generate a higher profit because of economies of scale. Variable costing does not allow you to do that. It's just a straight $8,000. If you produce whatever and you sell 2,000, then the profit's going to be 8,000 all the way across. All right, same kind of problem. Let's do another one. We can work maybe a little quicker on this one. So problem 2. Problem 2, we're going to sell 3,000 every year. We're going to produce 3,000, 5,000, and then 1,000. And our product costs are made up of. Now remember, the only difference in these two methods is how we handle your fixed product cost. All right, so let's calculate our sales. Our sales, in fact, I think the first thing we ought to go ahead and calculate the cost formulas here. I think that's helpful. See if you can do this. What would the cost of goods manufactured be? The cost of goods manufactured would be the fixed cost of 60,000 plus $15 per unit produced. So these two give us, this is product cost. So the cost to make one product, or to make any products, would be $15 times the units produced plus the 60,000. Cost of goods sold is going to be cost of goods manufactured divided by the units to get cost of per unit, times the units sold will give us cost of goods sold. What's the cost formula for Sgna? The cost formula for Sgna would be, instead of 8,000, it's going to be 9,000. And instead of being $12 per unit, it's going to be $10 per unit sold. So there's our two cost formulas. So let's see what we can do. Our sales are going to be here $50. We have the same selling prices we did before, and we sell 3,000. Now we know that's going to be the same all the way across. Our cost of goods sold. Let's first do cost of goods manufactured. Let's take the 60,000. The 60,000. Make it absolute, plus our $15 times the production of 3,000. So it looks like it's 105,000. 3,000 times 15 would be like 45,000 plus 60,000. Now we should be able to just copy this across. So we should have, this one would be 1,000 times 15 would be 15,000 plus the 60, 75,000. Yes. So we're going to take the cost divided by the units produced, which is 3,000. So we're left with the $35 here. Let's copy it across. So it's $27, economies of scale, and then if it costs you $75,000 to make 1,000, then that's going to be a cost per unit of $75 each. So that's diseconomies of scale. Our cost of goods sold is just simply going to be that cost times the number of units sold. Well, on the first one, it's still going to be 105,000. Then we'll copy it across. So it looks like this is our cost of goods sold number. No. The third one we're going to have to adjust. So that is 81,000. The third one we need to sell. We produced 5 and sold 3, so 2,000. So we have 2,000. That's going to cost us $27 each. Plus, we've got 1,000. That's going to cost us the $75 each. Add that up. Looks like that's going to be our cost of goods sold. All right, so let's put our cost of goods sold in. So it's 105,000, and we can copy it across. We know we can copy the 150,000. We'll calculate the sales minus the cost of goods sold. Bring that across. We'll have Sgna. Sgna is going to be the 9,000 plus the $10 times the 3,000 that we sold. That's going to be the same number all the way across. We'll just point to the 39,000. 39,000. So we have the first year 45 minus 39. The profit is 6,000. The profit grows to 30,000, and then the profit goes down to negative 18,000. We have a loss of 18,000. If we add all this up, what's our total profit? It's going to be the 18,000 is our total profit. So if we go to the variable income statement, we're going to take the $50 times the 3,000 that we sold, and we can just copy it across. Our variable cost is going to be the $15 plus the $10, that's each, times the number we sold, the 3,000 here. Our contribution margin will be 150 minus 75 is 75. Our fixed cost is just simply going to be, we don't even need a parentheses, it's going to be the 60,000 plus the 9,000. So that's 69,000, and then we'll take 75 minus 69. We've got 6,000. That agrees with the first year. Remember, we produce exactly what we sold, so it should be the same. And if we copied across, what we'll have is we'll have 6,000 for each year, and that's a total of 18,000. Here, this is a total of 18,000. But you see, it's dramatic when you have the traditional income statement where if you produce more, then your profit goes up. If you produce less, your profit goes down. All right, thanks for watching.